For those of you that are coming on in, there are a couple of seats in the front over here. Feel free to grab them. Thank you to the CLA for allowing us this opportunity to kind of share what we think is an important topic around capital market formation for the specialty finance community. I'm really glad that we didn't get to do this first thing in the morning because I think everybody's hungover over the game last night. So it's nice that we're in the middle of the day. But I'm also, on the other side, is I know that we're standing in between you and lunch. So we'll try to make this concise and thought-provoking at the same time. Feel free to come in. We've got a packed house here. So, the ecosystem has evolved rapidly over the last few years. We went from a period of very high rates to now into a period of quantitative easing and record amounts of dry powder in the system, particularly around private credit. We're going to unpack how originators seek capital, what types of story do they have to tell, and what are funders really looking for from both a debt and an equity perspective. Today, we have three excellent panelists who bring their perspectives on the side of the equation. To my immediate left is David Jens. Dave Jens runs Merchant Growth. He's an originator in the system. We have Noor Khan in the middle over there. Noor Khan is with Stream Asset Financial, and they've recently launched a new asset-based lending initiative. And then we have Keith Lamb in my far left, who's with BC Partners. They are not only a funder of debt, but also a provider of equity capital into the ecosystem as well. We won't go into specific bios per the instructions from the CLA, but they obviously all have LinkedIn profiles where you can connect with them. So I want to set the stage. I'm going to ask each one of you to describe what you're seeing right now in the market with one word. And we're going to start off with Keith in the far left over here.
Yeah, for me, I would say I might cheat a bit. So in the U.S., I would use the word frothy. And in Canada, I would use the word opportunities to describe kind of what we're seeing from BC Partners and the opportunities in the spec fin space.
Noor?
So the word I would use is discerning. We're finding a lot of people coming to us looking for capital. It's about who deserves the capital. So I would say discerning is the word I would use.
I would use the word favorable. I think there's a big capital overhang. The spreads are tight. I think the exception might be certain parts of real estate credit because of some of the performance and liquidity challenges in the private asset fund space there. But apart from that, I think it's generally a pretty good time to be an originator.
So those were very confusing answers. Thank you very much. But I think that's what I wanted to illustrate for the market for everybody today, that we're in a time where we are seeing frothiness, but we're also seeing opportunities and where we have to be discerning about what we're actually looking at and being thought-provoking in terms of our answers. I'm going to shift gears over to our friend Dave. Dave, you have been able to grow your business substantially over the last little while. I think you've reached a new milestone of $1 billion in loans funded. How have you thought about capital? In specific, how have you diversified your funding sources during that time and maintain your ability to meet the demand for small business loans?
Yeah, sure. So we've always been really focused on how we source our capital. We created our own private credit fund called Merchant Opportunities Fund 15 years ago. And what that's given us is a significant slug of stable equity that comes from hundreds of investors. We also have a leverage facility with BMO, National Bank, and Equitable. More recently, about 2 years ago, we got into a forward flow with Fortress because we saw a significant increase in origination because of a special initiative. And so we knew we needed to seek extra capital through that. But most importantly, I'd say the reason we've been able to stay really liquid and keep growing the capital base is because we've really focused on performance. Investing in the risk models, we frequently updating our credit policy every month based on what we're seeing in industries and geographies. Also keeping our portfolio duration really short. There's a temptation in our industry sometimes to push that term out because it's an easy way to grow your portfolio. And we've not done that so that we can respond to trends in uncertain environments. And so just really optimized the underwriting and created the kind of performance that our funding partners can be really proud of. And so our goal is to shine within their portfolio and be one of their favorites so that as we need to grow, they're there for us.
So diversity in the funding sources is what I took away from there. I also feel as though you did not just pick a path and just stuck with that the whole time and be totally dependent on it either, right? If you're getting funding from the likes of Bank of Montreal, but at the same time not afraid to work with folks like Fortress and also have your distribution within retail, it diversifies your funding resource.
Yeah,
Can I
super
ask?
important,
Can I ask a follow-up question though? What was the hardest to set up? Where have you found challenges in all those different funding sources?
Yeah, all
I
of them
stumped
are
you?
kind of hard. Like, I mean, our first institutional credit facility was took a super long time to get, and we budgeted 200 grand for legal, and it ended up being like 700. So that was annoying. In terms of standing up the retail distribution for our credit fund, that's also, the regulatory hoops with becoming an EMD, then becoming an IFM, getting your bear trustee agreement, getting approved by the CRO dealers, like all of that is like a huge, and then once you're done all that, you're not necessarily getting much inflows. You actually have to, meet people and convince them that your fund's a good option for their clients. So there's a lot of different ways to source capital. They're all difficult. And to your point, though, you want to have a nice mix.
And they're case specific. Perfect. I want to move over to the funding side of the table or the panel over here. Newer, as I mentioned earlier, you have stood up a new asset-based lending initiative over at SAF. Sounds quite exciting. Congratulations on helping launch that. Tell us why now? Why is this an important initiative for SAF right now?
Sure. It's kind of funny how things happen sometimes. One of my colleagues uses the word serendipity a lot when he describes what we're doing at SAF. And where that comes in is, I've had a very long career in banking, 30 years at RBC and other banks. And in RBC in Toronto, I always saw, there are huge gaps in our marketplace for if you're a smaller Canadian company who wants structured financing, good luck having any success with the banks. If you're a company doing subprime lending, good luck getting success with the banks. If you get money from the banks, good luck getting triple B, double B, single B money from the banks. So you could be a really good business, performing really well, but the big banks up here like to be basically as risk averse as possible. So that wasn't a problem for us at RBC. Lots of stuff to do, lots of big deals to be done, but there's a big gap in the ecosystem that was obvious to me for a long time. So when I left the banking business and figured I want to do one more thing, what do I want to do? I wanted to exploit that weakness. And I saw in the U.S. a huge ABF business where a lot of people are doing good business with smart operators in those spaces. And a colleague of mine introduced me to Ryan Dunfield, who runs SAF Group. And just by luck, serendipity, they'd been looking at ABF. They'd started doing NAV loans. They saw the growth in the U.S. market. And they also saw, there are lots of good Canadian companies who just need some capital. It could be debt or equity capital. And there aren't any Canadian providers of that capital. There are lots of U.S. players who come up here, they'll do a deal or two, they might come back, who knows. But our kind of thesis is there's a large hole in the Canadian lender space, and there aren't many Canadians filling that hole, and that's what we're trying to do here.
I'm going to ask Keith to kind of dovetail in that comment, but I will say, even though Keith works for an American firm, he likes to stress the fact that he is Canadian. So don't. But Keith, maybe I can just ask you, what are you seeing in the Canadian marketplace in terms of an opportunity, and how would you see that vis-a-vis what Noor just said?
Yeah, I think I would agree with those comments. I think the reason that we're increasingly actionable in the Canadian marketplace is we're just seeing a less competitive setup. It's less efficient. In the U.S., we see on each deal, it's the same guys. It's us, it's Carlyle, it's Blackstone, it's Apollo. Up here, we're not seeing that type of dynamic, and so we're seeing we can capture excess yield, covenants, eligibility criteria, things like that are a little bit more favorable to us than what we would be able to achieve in the U.S. So that's a great setup for us in terms of on a risk-adjusted basis in terms of deploying capital. It's just a better setup for us. Better. If we had to choose between the two, I think we'd choose to deploy more in Canada in the current environment.
I'll just add a comment to that. We've had clients where they've been well down the road on transactions, and they've had 5 U.S. lenders show them term sheets. We show up sometimes late to the game, and the fact we're local and Canadian and know the market will win the tie. So I think people do want to be with somebody who's understands the nuances of how is a Canadian resi mortgage different from a U.S. resi mortgage. What are these 5-year terms? What is all this kind of stuff? So I just think having a Canadian player is resonating with people.
I think if I could just add, I think on the deals we're seeing in Canada, I think I would classify it as being more relationship driven, whereas stuff in the US is definitely more transactional driven, so it's just one-offs here and there. But the Canadian market is definitely more longer term relationship focused right now, at least, which I think is the better way to approach it.
Let's continue on that theme, and I'm curious, Dave, what your thoughts are on it from an originator perspective. You have both Canadian and U.S. funders in your cap stack in different forms. You know, do you want to deal with Canadians? Do you want to deal with somebody more local, or you know, are you willing to take capital from anywhere because that's what you need? You're trying to solve a problem.
What Keith just said about it being more relationship driven in Canada really resonated with me. I mean, I don't really have that much of a U.S. perspective, to be honest. I mean, we have a few LPs in our fund. They're from the U.S. Those are also just happen to be more relationships anyways. Yeah, you know, yeah, I think it is. It's just such a smaller space that, you know, you're more likely to get the deal you want through cultivating a relationship than you are, you know, just trying to get a bunch of bids in this kind of market, I'd say.
Great. Let's talk about specifics around what funders or what capital providers are actually looking for right now. So I'm going to shift gears to Keith. Maybe you can answer this for me. What asset classes are you finding the most attractive right now? I know BC Partners looks at a lot of different things at the same time and has certain specialties where they are incredibly strong in. Where are you finding opportunities in the current market today, given where we're at?
I think we're seeing the most activity right now. I would say in Canada, it's pretty broad-based. The only area we're maybe a little bit cautious about is in the consumer lending space, where there's some interest rate regulatory changes. And it's not that we don't like it, it's just we don't have enough data yet to see how it's going to perform. So I think that's a stay tuned or to be determined. Other areas where we're seeing a lot of activity and we really like: home improvement, merchant cash advance, or small business lending, medical receivable financing. So things like if you're going into a dentist and you're financing a dental procedure or orthodontic procedure, a little bit of med spa, stuff like that is quite attractive. I would say those are kind of the 2 or 3 big areas where we're seeing a lot of opportunities kind of poke their heads up right now.
And you're going up and down the cap stack in a lot of senses. You know, as I mentioned, debt provider, also looking at equity opportunities. How are you deciding between, you know, this is an asset class that I only want to provide debt to, or this is an asset class that I actually would be considering taking an equity stake in?
Yeah, I think I would answer that. So at BC Partners, we have various different types of capital pools. We have traditional kind of credit funds. We have an insurance vehicle internally, not too dissimilar to like an Apollo Athene. We have BDC capital. We have venture debt capital. So it's really our decision, debt versus equity, is going to be driven on what pool of capital we're trying to fill. So for example, on the insurance side of the business, we're constantly looking for product to satisfy that balance sheet because it's permanent capital, it's continuously growing. And if we have an opportunity to work with an originator, make an equity investment to secure access to quality paper that can get rated and fit our balance sheet needs, that's a very attractive setup for us. And that's where we look to make acquisitions. And we can own 25% stakes in origination platforms. Some cases we own entire origination stakes, or entire 100% equity stakes in origination platforms. So for example, we own a litigation finance platform, 100% of it. It produces very esoteric, unique paper. It can get rated, and it fits our balance sheet needs from a duration and yield perspective.
Noor, how are you thinking about the various asset classes that you're participating in right now? What's attractive today to you in this marketplace?
Yeah, sure. So I mean, the moment we've closed our first deal, which is a resi mortgage deal. Right now, we have a credit card deal, an auto loan deal. So we're working at stuff across the world. We also see, for example, in the equipment sector, potentially a lot of need. It's finding the right players. So we are. I mean, I describe ourselves as asset agnostic. Where we're seeing the most demand at the moment actually happens to be in the resi mortgage space. A lot of lenders are trying to make money in the all-day non-B20 space. So we are talking to lots of people about possibly helping them there. And I'd echo a lot of what Keith was saying in terms of how we look at transactions as well, because we too have different pools of capital. Some people want more risk. Now, SAF has a long track record outside ABF. So we're getting inbounds from people saying, can you find investments for us in the equity side? So now we weren't planning to do equity investments like in our first year of being up in the ABF space, but we are now looking at equity as well. So it really comes down to, where is the risk return, something you can live with, you can justify to the committee. You could be in the debt, you could be in the mezz, you could be junior, you could be equity. So every deal is sort of bespoke.
Great. I appreciate that. Maybe we can talk a little bit about, advice for the room here. In the room, we're going to have a number of non-bank lenders, fintechs, folks that are either mature in their businesses or they're just starting up. I want to ask Dave. You have again been able to grow your business fairly substantially, seek out many forms of different funding sources, and been able to advance into a more mature stage, I would say. Impart some wisdom into the group here. What are the top 3 or 4 things that you would say to an originator in terms of raising capital?
All right, I'll do my best.
Pressure's on.
Yeah, I mean, what I'm going to say might sound simple, but really, to just spend a lot of time thinking about and executing your capital formation plan, kind of almost like starting with that. I think a mistake, and because I've got this credit fund, merchant opportunities fund, we also work with originators. So some of my life, I kind of wear more, a Nur and Keith hat. And so I see these early stage originators, and there's like I'm a fintech platform and I'm focused on product. I'm going to focus on my customer, build a great experience. And it's sort of like following the sort of Silicon Valley mentality that, Elon Musk is like, spend more time on product. You should spend less time on finance. Spend more time on product. Bezos saying obsessed with the customer. But that doesn't apply if your business is finance. Then you actually have to spend more time on finance. And you have 2 sets of customers. You got your borrowers and you have whoever's investing in your pool of loans. So they're super important. And I think sometimes the mentality is if I have a good product and I can find borrowers, the money will kind of find me. And that's just not how it works. I think I was kind of lucky. I started my career in finance. I worked in private equity, so like funds and thinking about finance was kind of where I came at this from. So the first question, I asked myself was, can I, engineer a sticky, scalable, and diverse capital base? That was kind of, I started with that, and I figured if I can find the money, then I'll be able to find the borrowers. So, prioritizing it kind of in that order, I think is important, and I think maybe some originators need to kind of hear that.
You forgot to mention hire an advisor? No?
They found our first debt
no,
facility. He found our first institutional debt facility, where the legal bill ended up.
I'm nothing if I can't put in a plug for Ventum Financial. I cannot do that. So, let's go back to the funding side. So, from your perspective, Noor, what are the key traits for an originator that you look into?
Sure. I mean, there are a few things I'd throw out there. I hope they're fairly obvious, but I'll give them anyway. The first one is we want people with focus. If somebody comes to us with, I'm doing 7 different things, and here's why I think it's a good idea, but it's kind of like Johnny come lately, I'm copying someone who's doing this, someone doing that, that doesn't really impress the committee. So, somebody has a very clear vision of here is the value we're adding, here's why we're good at this is our focus, this is our knitting, this is what we do. So that's very, very important to us. In terms of more tactical, and this is from a long career in banking, I came by the gray hair quite naturally. The things we saw that blew up companies, especially back in 2008, was lack of liquidity. You have to have liquidity sources. There were companies who were running along just fine, but they didn't have committed funding sources. They didn't want to pay for commitments. So sometimes trying to cheap out by saying I'm not going to pay for a commitment. If times are good, fantastic. The second times turn bad, you're in trouble. So having committed liquidity, I found, is very, very important. Also, diversification of funding. People who have 1 or 2 banking partners or funding partners, again, when times are good, fantastic. What if that banking partner changes their strategy, changes their mind, whatever it is? Now you're left high and dry. So I would say liquidity, diversification, focus, and then sort of selfishly from a lending perspective, we like people with a track record. It might not necessarily be that you've done this exact thing for 10 years, but maybe you've had success doing a similar thing somewhere else for 10 years, and you can leverage that, port that over to here. So in summary, I would say, experience, focus, liquidity, and diversification.
I'll just double down on that real quick, if you don't mind, which is just that, I think it's like the case for why you should start by focusing on getting the capital is, what is the thing that blows these businesses up? It's if the funding gets pulled. That more than anything else is what actually kills these businesses. And I think as an entrepreneur, your job is to be paranoid and thinking about what could blow you up. And that's the thing that is most likely to blow you up. There's other things that maybe could blow you up, but that is the most likely. And so hence it should be super high on your list of things to be thinking about.
Yeah, I would also echo that. I think in cases where there's origination platforms that we're evaluating, like Nir said, like diversified funding sources, whether it's having ABF, some combination of asset-based finance facilities, forward flow, some other type of funding, and having multiple partners, I think is obviously very prudent. And then for the origination platforms that don't have that, one of the first things we do when we do acquire them and partner with them is start to put those in place as a fail-safe. We saw that happen through the COVID period, and all sorts of weird stuff was happening with funding partners. Some just ceased funding. You can go to court later and figure it out, but by then your business is, in quite a bit of trouble. But it's just, being paranoid and having all those fail safes, I think is definitely something to consider.
So Keith, as you know, we work with a lot of firms kind of getting to that stage of being institutionally bankable, like we like to say. So from that vein, what does a company kind of need in terms of data, in terms of information about themselves to be, quote unquote, institutionally bankable?
Yeah, I think for us, I would say that we're very quantitative or data driven. So when we're evaluating prospects, the first thing that we would honestly look for is a very robust data room. That would include things like loan loss curves, prepayment curves, a full loan tape, aging roll forwards and things like that. A lot of the times, especially we're running to it more so in the Canadian marketplace, is a lot of the originators aren't necessarily prepared with that type of information, so it just needs a little bit of coaching. But there are advisors, like Ventum and others,
Appreciate that.
that can guide you through that process. But I would say 80% of our work is going to be spent on digging through loan tapes and data tapes to figure out how your loan and how your product performs, because if we can't get comfortable with that, there's no way that we can put a facility in place. It's just as simple as that.
Anything you want to add to that, Noor?
I concur completely. I mean, it's so important to us. Our first hire in Toronto that I'm hiring is somebody to do exactly this. We have people who can do deals, but we need people who can crack tapes. So I agree that sometimes Canadian companies don't have the data in the same form as a big US company, but with some coaching, some help, we find most people can get there.
And I would just say, like, the smartest thing I did from this perspective, from the originator hat, was bringing my business partner Peleg, whose his title is president and CFO of Merchant Growth. He joined me in 2017, right at the time we were getting that first institutional credit facility. And I just had too much on my plate. There's no way I could have managed it all and had super clean data that folks like these need to see to grow. So bringing on a super key person, if you don't have the bandwidth to do it yourself, would be the next thing.
We're going to stick with you for a second, Dave. I'm just going to ask you, because I'll be honest with you, hearing the answers here on the panel, it sounds sometimes a little bit of a chicken and the egg thing. We want to make sure that we have equity available there. We want to make sure that there's diversified funding sources. We want to make sure you have a track record. But for the originators that are just starting out, and you were there a while back ago, and you need that first equity piece of capital to come into the business, how did you charm them?
So I started this fund because I was 22 when I started this business. I had no money. And I started this fund to start making loans. And my first investor for $80,000 was my mom. So I charmed her by being her son.
Okay, who was it? Who was the second?
Yeah. So anyway, after that, it was, honestly, I was just having coffees with people and getting $5-10 grand at a time. It was kind of really... I wouldn't necessarily recommend it. I mean, if you're a little later in your career and kind of, you have the ability to, but yeah, at that stage, at that age, the name of the game was small checks, just club them together. And then over time, obviously started to get bigger and bigger investors, put a board together. Some of those board members had bigger networks. They started to bring those networks in, it starts to get going. But, we grew off a really small base for a bunch of years. So, yeah.
Shout out to Dave's mom. So, maybe if I can just continue on with you for a second, where do you see the lender finance market going now?
I think these guys are probably going to have more insight on that. But, I think that maybe, for Canada, it'll start to move a little less relationship, more into transactional. And as the data becomes cleaner, more readily available, maybe platforms pop up to kind of help facilitate the flow of information between originators and lenders. I know there's a bunch of fintechs working on that too. But yeah, I think probably, over time we'll get a little bit more efficient. Not quite probably ever to the efficiency you see in the U.S., but through technology and just maturation, we'll see a more efficient market here over time, I'd imagine.
Great. For the funders on the panel, where do you see the market going? And specifically, what's top of my mind is we've seen such a rapid growth in private credit chasing the space, whether it be in the U.S. or even now in Canada with SAF as well. How has that changed to kind of advance rates, how they're looking at the asset classes and borrowing criteria? Keith, go ahead. Yeah.
I would say, as private credit becomes more developed or continues to mature in the Canadian marketplace, we're seeing origination platforms become more sophisticated and move up that education curve in terms of being able to provide us with the data and information, policies and procedures, all the stuff that we need to see to get comfortable around an investment. I think that will improve liquidity over time. And like David said, I think, maybe it becomes a little bit more transactional as a result of that, but I don't necessarily think that's a bad thing. I think, having some relationship-driven activity and with some transactional will be good for the marketplace as a whole. But I think, as the liquidity improves, we'll see advance rates get a little bit more generous, eligibility criteria, financial covenants become a little bit more forgiving, because right now I can honestly say, like, when we're doing deals, that criteria is quite restrictive, until we get more comfortable with platforms and build a track record and have that relationship fully kind of built out. And until then, it's not optimal.
So I'm sorry, pardon me. I had a couple of comments. Number one, there is dry powder to be had, so you might think that means people do weaker deals. But the way I'd put it is, I'd rather have dry powder sitting in my box versus spending that powder and having it blow up on me. So, I would hope people don't get lax or careless in deal structuring just because they have money to put to work. That's a very short-term approach. In terms of where do I see the market going, and we're saying it's very early days for us, but what I'm hoping is two things. We were able to maintain what I'd call the more Canadian relationship approach to doing deals versus the U.S. transactional approach, while getting some of the efficiencies of the U.S. market. And what we're seeing already is as people are seeing there's capital to be had, we're having people approach us and saying, hey, can you give us some equity funding? People approaching us, can you do forward flow agreements with us? So I'm hoping to be able to have a market up here that maintains the Canadianness of how we do deals with the efficiencies and structures that the U.S. has done such an amazing job developing and growing.
Wonderful. So just in closing, I think that's the amount of time that we have for today. Just want to say thank you, Keith. Thank you, Noor. Thank you, Dave, for imparting some wisdom into the audience today. Really appreciate the time and effort. Look, this is obviously a pretty important topic for the community. Judging by the amount of people in this room, it's of interest. So really appreciate your time. Thank you to the CLA. Thank you to Tal and Gary for all the effort that they do for the ecosystem. And I'm sure everybody will make themselves available for questions afterwards. So feel free to reach out. Thank you, everybody.
Thank you. Thank you.